Hi, I'm Samantha Rowan, the Managing Editor of Real Estate, Finance, and Investment, and this is Refi TV. Our guest today is Jamie Hisiger, a partner at Latham and Watkins, and Global Chair of the Real Estate Practice. Thank you for being here today, Jamie.
Thank you for inviting me.
We're starting to see some mergers in the real estate investment trust sector, specifically among industrial and healthcare REITs. Is this the start of a new wave of M&A activity?
It's an interesting question because of what you are seeing. You're seeing, as you mentioned, healthcare. Very, very easy to look at for the last well over a year, 18, 24 months. It's one of our strongest sectors, and therefore we think that it would make sense to see that kind of consolidation, mergers, etc. But we're not seeing it in retail. We're not really seeing it in office. We see some activity in hotels, but not that much. So as a true barometer of where we're going, I don't think it's there yet. I think if you took a look at AMB and Prologix, I think there you could take a look and say, okay, there's an interesting one, which is probably economy of scale. I think there was a report that they would save a significant amount of money because of bringing the two companies together. But we haven't seen it that much out there yet. We haven't really seen it in the other sectors. So I don't really think I can tell you that, yes, it is definitely the trend. But on the other hand, if you take a look at IPOs, and they're very slow overall, we've seen some REITs start and stop, and we did a nice one, frankly, for Carlisle, which has done well, but we haven't seen that many this year, even last quarter of last year. So do we see more mergers because of that? That's a possibility, in that they're not getting the pricing that they want in an IPO. So maybe they become a target, or maybe they become the actual acquirer. So that's a possibility that will drive that, because the IPO market's not as strong as we had anticipated at this point. And therefore there's an appetite to be maybe bought up or taken over and get back to the economy of scale, people buying management, etc. So that's a very real possibility, but I don't think we're there yet. I don't think I could really tell you today, that as you ask the question, is this the new wave? We don't really see it that much yet. I think when we see the other sectors coming together, then maybe we'll have that conversation again.
So a little bit down the line.
A little bit, maybe more a little bit, because of some of the activities that we're seeing in the United States, but more so the effect of the world on the United States. So maybe a little more than just down the line, but we'll see. Hopefully you're right.
That leads me into our next question. I'm very interested right now in the number of exogenous pressures on the U.S. commercial real estate market. There's a lot of turmoil in the Middle East that's having an effect on oil prices, and the recent tsunami and nuclear disaster in Japan, for example, have had an impact on the Hawaii kind of retail and hospitality market. There's also concerns over inflation. How do you see these events affecting the bricks and mortar business of commercial real estate in the U.S.?
Interesting question. Again, thinking about what we just talked about, the outside forces looking at the United States, it's about uncertainty, and people just don't know what's going on. And if we've spent the last few years coming out of uncertainty and trying to stabilize the markets, and I think we've gotten to some point where there's a stabilization, maybe we're still going down, but possibly not the same losses that we were seeing just a few months ago, let alone years ago. That uncertainty then brings us back to start thinking about that again, and then I think that's a real problem. And the problem is what happened. So it's Japan, it's the Middle East. It's the Middle East and Japan from points of view of just cost of everything, all materials going up, everything starts to increase, all the costs start to go up, and therefore, as you even said yourself, you have now additional impact upon inflation, where we all thought inflation was going to come no matter what because of what the United States is spending. Not going to get into the politics and the problems that are there, but if you think about just from an economic point of view, spending a significant amount of money, inflation has to come. Does this bring that about even faster? On the other hand, you could tell me maybe that works for real estate. I mean, then there's a additional flight. Right now, I always talk about there's a flight to quality today. There still is, and I think that the outside forces of the world brings that to the forefront, that we are maybe seeing those different sectors like hotel or retail, seeing that stabilization, maybe office better than retail. But my point is that the uncertainty, you flight to quality. The United States is quality, therefore there might be more investment. More investment brings on more competition. So each one can feed on each other and become strong. On the other hand, as I said, we could be worried about inflation and everything starts to cost more. We mentioned the hotel sector getting a little stronger. We're seeing that in the world, in the United States for sure, but if all of a sudden we're back to staycations rather than vacations, remember those words from a few years ago? If we're back to that, then that's a real issue, because who's going to be staying in the hotels? Will people go into Disneyland? Will you start to see that once again be an issue, that people aren't going to spend the money for business travel, not going to spend the money for resort, etc. So are we going to see once again we're back into that hole? Who's to say? I don't know, but it's definitely, definitely in front of us, unfortunately, but we don't really know. I think the real issue is going to be that people like the United States, they want to see their money in the United States. We're very stable in the United States, and therefore maybe we're going to go ahead and make it through. So far the indexes show pretty much strong and stability, but it's a little concerned that it's uncertainty.
The other concern, I think, among a lot of commercial real estate executives, too, is that all of the money is going into the quality buildings and the quality markets. And there's not so much in the tertiary markets. We're seeing maybe a little secondary market activity, but there's a worry that prices are getting inflated for the core Class A, New York offices or Los Angeles offices. Or
that's the flight to quality. It's New York, D.C., Chicago, L.A., and then, you could take a look at some other cities, of course. But yeah, you're right. When you think about it, and with the government that we have, D.C. seems to be doing well. I've read your publication a few times. You've reported on some transfers that have shown some very, very strong numbers. As a matter of fact, especially for even for the past few years in D.C. And that will probably continue, because quality is quality, and people will invest in it.
Sure. Switching gears a little bit, you and I had talked, I think a few weeks ago, just about how more borrowers and lenders are willing to work out troubled loans. There's a number of ways they could do that: discounted payoffs, deeds in lieu, other negotiated settlements. What's driving this increased willingness of the borrowers to work out loans, whereas a year ago they were kind of just hold steady and see if they could ride it through?
I think it's the continuing theme that we're seeing ourselves in 2011. We're seeing that stability. I'm not suggesting that things are getting better, that things are going great, great guns once again. No, I'm saying that if we saw value start to drop, and it dropped 10, 20, 30%, and it just continued, then there'd be nothing to do at that point. No one knows what to do. And then all of a sudden, if we've seen stabilization, that we're not seeing those type of precipitous drops any longer, then you've got lenders and you've got the borrowers, the developers, owners, operators, management coming in to say, we can understand where the market is, we can now price the item. You've read significant amount of stories about people out there putting additional equity into transactions, writing down debt, lenders taking equity. All those different forces come to play when we didn't know what was happening, meaning you're going to take it back. But now people there's a comfort level to say, okay, I can operate a 70+% occupant. I can operate a hotel at a different number than we were seeing before. That was such an impact, if you will, on the ability to go ahead and just run the thing. Now you've got lenders back in the game who are saying, I don't know how to manage that asset. I don't know what to do with that asset. But you did. You did nothing wrong. So let's keep management in place. Let's think about a transaction that we can do. And on some extent, we've even seen the federal government do it. On some of the loan portfolios that they've been selling, they're not selling off 100% anymore. They're not selling it off at a huge discount anymore. Still a discount. I'm not suggesting it hasn't gone up, but they're also taking positions. They don't want to be idiots, and they want to be supported on the back end. So on some deals I've been looking at, and a couple of clients have looked at, and one of our clients actually have won a portfolio. There's an actual, almost a joint venture feel that you will take the property forward, you will generate X amount of income, but there's a sharing by the feds, so that there's no longer this wholesale thought of just get rid of everything that we have. There's more of this mindset of, we're going to do this together, you're going to put money in, you'll get your capital back, but there's going to be a sharing of the upside. And we've seen that in a couple of deals already. So I think that itself is a strong indication that people see that stability. Again, I don't see a huge change. 2-3 years, if there's a long enough hold for those assets and the government gets paid back, then everybody wins, meaning the person who put the money in, the feds who had to take the paper back. But I see that as one of the stronger changes. And also the other side of that is that people understand the documents a little better. Before you would go ahead and just give the paper, you gave the paper back. Years and years and years ago, it used to be you filed for bankruptcy to hold on to the assets as long as you could. So today, documentation, not today of course, but years ago, but today people understand they can't just do that. They can't just fight with the lender. It's much more of a joint participation about what can or can't be done. The mezz lenders come in to throw equity into the deal, to try to make the transaction work, to protect their assets. We've seen it on many deals. I'm not saying anything that you really don't know, but it's just a reiteration of what we've seen and more of it, where it used to be just take it back and move on with life. It's more now, how do we protect the asset, how do we work together and take it forward, because we think that there's that end of the tunnel that people can do well with. And I think that's more or less of what's driving where we are.
It's interesting, too, that you mentioned that the federal government is getting more involved in almost a, I don't want to say a hope note situation, but where they would participate in the upside, because that's proven very profitable for them with a lot of the investments they made in financial services institutions at the start of the financial crisis. Correct,
and I think it's more than a hope note. I think the hope notes, we use them more or less even 12 months ago. I think you're right, though. I think it's a good point. They're holding a larger percentage, and therefore not so much the hope, but a real understand that they expect to get some type of return because they've gotten it, and that's, people use different words I'll use for this conversation. I don't want to be an idiot and just give it away for 50 cents on the dollar, 45 cents on the dollar, but we've also seen those type of discounts tighten up. We've seen lenders who were out there wholesaling a lot of different things move those numbers up as well. So it's kind of interesting that people getting together. But your question also goes to the borrower working with the lender, and I think a fact of that also still is the low interest rates. So there's still money out there. You're still trying to work together. It's better to keep it on the books and work the asset rather than take the losses on it and then go ahead and have to deal with the new regulatory environment within DC that they want to see monies being held, monies in the deal. I mean, when we take a look at CMBS or whatever it might be. So if you think of it that way, I think that's all bringing the forces to bear that the borrowers are working with the lenders, or I should say, that the lenders are working with the borrowers.